Hi, my name is Larry Furrier, and today I will discuss the pros and cons of fixed income and dividend-paying equities. Let's start by briefly explaining how fixed income securities work. Fixed income securities pay a stated interest rate, usually in semi-annual payments. They have a stated maturity, and they will pay unless the issuer files for bankruptcy. Bonds are rated by rating agencies like S&P and Moody's, and the rating can indicate the credit risk that an investor can expect to experience. Lower rated bonds will carry a higher yield to compensate for the higher credit risk. Higher rated bonds will have a lower yield due to the lower risk taken by the investor. The pros of investing in fixed income securities are a fixed rate of interest, a stated maturity with principal returned at maturity, call features that can exist, ratings by S&P and Moody's help evaluate the risk, and bonds have priority over common stockholders in the event of a restructure. The cons are the yields can be affected by the market, so that in a low interest rate market, the price will rise, lowering the yield, and in a higher interest rate market, the price will lower, causing a higher yield. Shorter maturities will have lower interest rates or yields. Issuers are obligated for the payment, and if they experience financial difficulties, payment can be delayed or stopped. Now, let's talk about dividend-paying equities and or mutual funds. There are several companies that pay a cash dividend, like British Petroleum or AT&T, and there are many exchange-traded mutual funds that pay cash dividends. These dividends are usually paid monthly or quarterly. Some exchange-traded funds have paid monthly or quarterly dividends for over 25 years. These make excellent investment for investors looking for cash flow for their retirement years. The pros in investing in a dividend-paying equity are there are numerous equities that have been paying cash dividends, and the yield is based upon the annual payment of the dividends divided by the market price. For example, if a company pays 30 cents per share quarterly, that would equal to $1.20 annually, and if the market price of the stock is $25 per share, the dividend yield would be 4.8%. If the stock pays 10 cents a share monthly, and you multiply that by 12 to get an annual payment of $1.20, and if the market price is $15 a share, you would divide $1.20 by 15 to get an 8% yield. Exchange-traded funds can combine numerous companies, which help the diversification to prevent exposure to one industry reaction to the market. For example, gas and oil companies' stock will fluctuate with the price of oil and supply and demand. Many companies are very recognizable, and clients know the products that they produce. Dividend history of equities can be easily researched by searching on various search engines by simply typing the symbol of the stock or fund, the dividend history, and several different sites will give you the history of the dividend payments. The more consistent history can be a way to evaluate if you choose to invest. But there's no way to predict if the dividends will continue to be paid at the same level. History can be helpful before making a decision to invest. Liquidities of exchange-traded funds or individual stocks can make it very easy to purchase or sell because they trade on stock exchanges. The exchange-traded funds are a good instrument for IRAs when it becomes time to retire and you are looking for monthly income. Dividends can be reinvested for additional shares without a commission charge to the client. The cons are dividends can be reduced or not declared at all during economic downfall or stress. Individual stocks can file for bankruptcy, and common stockholders are the last group to be paid in a restructure of a company. Market values can decrease due to various factors, and since there's not a stated maturity, the values could be less when you decide to sell. Market values will be affected if a dividend is reduced or not declared, as investors can see that as a sign of weakness or trouble for the company. Companies can sell off assets or spin off subsidiaries that help make up the cash dividends history, and that can affect the price of the stock or the dividend's future payments. If you have any questions, please reach out to us and call us, at 800-868-6864, and you can find more information about us on our website at amuni.com. Thank you for watching, and if you like this video, please don't forget to subscribe.